Welcome back. We are watching oil markets today after Venezuela's leader, Nicolas Maduro, was captured by the U.S. this weekend. And while U.S. President Donald Trump is using drug charges to justify this military operation, the move certainly has something to do with oil, as Trump says the U.S. will be taking control of Venezuela's massive oil reserves. Our next guest says this big news from the weekend doesn't seem to be impacting the markets, as oil has been basically unchanged since Maduro's capture. Here to tell us more is John Zechner, chairman and founder of Zechner Associates. It's good to have you this morning, sir. Thanks for taking the time.
And good morning, Lindsay. Happy New Year to you.
Happy New Year to you as well. So when you're watching oil markets this morning and oil prices, you're not really surprised by the fact that they're kind of steadying out?
Well, it's funny when you saw the news on the weekend. It certainly was a big event, and but yeah, it's not really a big event for the oil markets nor for the stock market. I think, in point of the view of the oil markets, I mean, I guess the reality is Venezuela, even though they're sitting on the world's largest reserves of oil, they're only producing about 1 million barrels a day, and that's basically all going to China. And has a pretty good backlog right now of stocks, so that's not going to make a big difference. I mean, ever since Hugo Chavez came in the mid '90s, I mean, Venezuelan oil was close to 4 million barrels a day, and now it's been decreasing ever since. So whatever ends up happening with the U.S. taking control here, and maybe they can sort of start to increase production again. It's going to take a long time. That's a hard regime to go into. The opposition is somewhat still in control. You've got gangs sort of on the streets. You've got it's hard to get equipment in there and run it. And yeah, Chevron when it was nationalized was the last one in there. So maybe that's why there's more optimism around Chevron and Exxon today, that they'll have the better ability to increase over time. But it's going to be a long haul, Lindsay. And on the other side, I guess ultimately for Canada, if they did increase production again, it would be a negative, obviously, because they are a big producer of heavy oil, and most of that heavy oil will probably end up going to the U.S. under this scenario, and that would compete with Canadian heavy oil. So it's a bit of a risk for us. So that's the way it stands. But markets are shrugging at this right now. It's interesting though. The biggest move is actually in the gold market this morning, which is a whole different story on what we're seeing in terms of geopolitical risk.
Okay, I want to ask you about the gold market just in a moment, but just going back to what you said about Canada's oil market, right? Because as you say, the heavy crude that Canada produces is very similar to the heavy crude that comes out of Venezuela. So do you think that there's any risk here to the Canadian oil market in the U.S., or do you think, because as you say, it's going to take a long, long time to really access that Venezuelan oil, that Canada really doesn't have anything to worry about right now?
It'll take a long time, Lindsay. I mean, rebuilding the infrastructure just to, get the production going, getting it out of the country, and then how you transport it, whether by ship or whatever, into the U.S. versus, Canada, we're still sending it down by pipelines to, U.S. refineries that are able to take the heavy, our heavy crude. So, yeah, it could ultimately be a long-term factor, but it's nothing that's going to impact the market anytime soon. So, any market reaction, I think, in the short term from Canadian stocks, I'd call it an overreaction.
An overreaction. And you say the ultimate winners here could be the oil infrastructure companies that will need to really ramp up production as well.
Yeah, absolutely. I mean, the guys who are, the Halliburtons of the world and the bigger players going to go in there and sort of rebuild the infrastructure and the delivery and everything else. But it's like I keep saying that I just think this is a tougher job. I mean, you look at, things like mining in West Africa and other these things, and how difficult it is where you don't have a stable geopolitical environment, and how much more it costs. I mean, an oil worker really wants to go down there with armed guards around him 24 hours a day, worrying what's going to happen. I don't think it's going to be a big impact anytime soon. It's just a headline right now.
Okay, but the big impact, what you're saying, is what you're seeing in the gold market today. So tell us about, we're seeing gold prices rising. What are you seeing there?
Yeah, that's interesting, because I think that's more a statement in my mind on the geopolitical risk increasing, basically on what Trump is doing here, going in and taking the leader of a foreign country like that, pulling them out. I mean, I think global markets are getting more and more worried about sort of U.S. acting on a more authoritarian basis. Trump is clearly bypassing Congress completely on all of this. I mean, he did on tariffs, where you're supposed to get approval from Congress, and a lot of the other recent moves, which whether it's in Iran or other places in the world. Now they're talking Greenland again, and certainly what they're doing in Venezuela and overall in South America. And I think worries are that he's acting just more dictatorial on that basis, and that instability worries markets, and it certainly takes global investors a little more out of the U.S. dollar again and puts some risk there. And as soon as the US dollar comes under some pressure, gold is the immediate beneficiary of that. So, I mean, it's a pretty big move to the upside today. I think it may be more speculative players. I mean, central bankers have been the big buyers of gold, but everybody else seems to be joining into the market, and as you say, is the big winner this morning.
Okay, so much has happened, and it really just a couple days into 2026. So I want to talk about the markets in general as we head into a new year, what you're expecting after the run we saw last year. You have mentioned as well that 2026 is a midterm election year in the U.S. How do you foresee things playing out in terms of how the markets will do this year?
Yeah, and in terms of, I know the expectations are for about 10% gain for the market from all the strategists that did the year-end projections. Yeah, if I was a betting man, I take the under on that one, quite honestly. I just think there's still some headwinds. You've had 3 great years. It's hard to get, double-digit returns 4 years in a row. As you mentioned, midterm elections are generally the toughest year of the presidential cycle. So there's that. Valuations are at an all-time high, by many, whatever metrics you want to take. And, there's obviously geopolitical and economic risk. We don't know what's going on. You can be changing the head of the Federal Reserve in the U.S. I don't even know whether interest rates drop as much as markets are expecting, given inflation is not coming down, and growth is not slowing down because you've got such massive fiscal stimulus out there, particularly in the U.S., which, running 6% GDP deficits, in peacetime and non-recessionary time is almost unheard of. So, but all those risks out there. So we're pretty defensive in where we're going, looking for income producers, looking for lower valuation stocks, not pulling the tech bet, but even within technology, I'm sort of moving out of the AI plays more, and some of the laggards like the software companies that seem to be reflecting the worst of all worlds and are trading at reduced multiples. So we're just looking for decent places to hide, staying involved in the market, but looking more for income, lower valuation, stability in earnings, as opposed to sort of chasing some of the higher beta, economically sensitive plays.
Is that how you think investors should be heading into 2026 if they kind of want to refresh their portfolio, maybe diversify a little more, as you say, lower valuation stocks, getting away from AI maybe a little bit?
Well, I think absolutely. I mean, you look at the average investor, and you look at the index weightings, because there's so much passive money out there. So passive money is in the index, and one of the indexes, 45%. I heard you talking to guest earlier, 45%, tech and telecom. I mean, that's a massive weight. I mean, the six biggest stocks in the U.S. are worth $25 trillion, which is 150% higher than the entire S&P 500 at the peak of the tech bubble in 2000. So yeah, you've got a lot of concentration risk. You've got extreme bullishness in the U.S. Retail investors are playing to a hard degree, and you got some very high valuation stocks. So when these things start to come down, they don't drop, 5, 10, 15%. These are things that go down 60, 80%. I mean, even look at something like Oracle, when it peaked in September, and then the bloom comes off the rose a little bit, turn around and it's down 40%. So, I mean, these moves happen quickly and dramatically, and I think investors have to be wary of that. And, you never went broke taking a profit, is the old adage. Go with that. Take some of the gains. Now we're into a new year. You don't have to worry about paying taxes on it. Take some gains and get a little more defensive in your overall holdings. Have some bonds in there. I mean, U.S. long-term bonds at almost a 5% yield. Canada almost 4%. It's a nice portfolio hedge. It's some income, and if interest rates do fall, they'll appreciate on top of that. So.
And just lastly, before we let you go, you mentioned the software sector. Are there any stocks in particular in that sector that you like?
Yeah, I mean, we've actually in Canada, bought Constellation Software this year. It had its worst year in a long time. And I think, the story is still intact and the valuation is much more reasonable. In the US, names like Salesforce with his Agentforce rollout, a good AI play. Adobe, I mean, they've written the thing off as being demolished by AI in general. But I mean, everybody's still got Acrobat out there. I think they'll continue to use. And yet, it's trading at 15 times current earnings, which is crazy in my mind. It's still growing over 10%. So there's lots of spots that I think of, are safer and won't be impacted as negatively as maybe the market is anticipating.
Okay, John Zechner, chairman and founder of Zechner Associates. Always good to have you join us. Thanks so much.
Thanks, Lindsay.